Well, the current challenges facing income seekers in today's market are manyfold, but two that spring to mind are the risk of overpaying for income. It's been very fashionable to chase yield, to chase coupons and fixed income in investing over the past few years, and anything that's fashionable just makes it more expensive. So there's a great risk of overpaying, so you need to be very careful and very selective about which sources of income, be it in dividend space or be it coupons in the fixed income universe, that investors are going for. So taking too much risk is one of them. The other is the ability to actually finance a sustainable stream of income. So being able to comfortably invest the capital and sleep at night knowing that the capital's being looked after and generating an income stream on a sustainable basis, because increasingly we're having to contemplate retirements which are lasting many years longer than previous generations and which are facing a much broader set of costs and financial obligations, not only for themselves but for the wider family. So looking after both the capital and the income is the increasing challenge. Well, when we're looking for our individual equity exposures, it's very important that we do two things. We minimize the stock-specific risks, so we don't hold very much of any individual holding, but we maximize their collective characteristics. We want their shared characteristics to be the same as our overall priority as a portfolio, and that is to generate a growing income stream. So we want underlying holdings in that fund that generate a growing stream of dividend payouts. So we look for companies and we screen for companies that have, as a corporate policy, year in, year out, the very first question they ask themselves at their annual general meeting is, by how much shall we increase our dividend? And do these companies do it from a sustainable base? So we'll have some balance sheet metrics that we'll look at, and we'll simply try and be as mechanistic as we can and remove ourselves from that decision. It's very important to us as asset allocators looking to grow capital that we remove any subjectivity from the decision over which individual stocks. We're not stock picking here. We're looking at the collective characteristics of dividend growers. So it's very important, and it helps us to avoid overpaying, is to look for those characteristics over and above having any explicit dividend yield target, because that's the road to overpaying for dividend income. There are two fantastic examples, one very recent in terms of episodic behavior, to use that terminology, in the middle of October. So for the first couple of weeks of October, we saw, for whatever reason, there were many reasons and rationale being used by the market, be it scares from European growth and deflationary forces seen to be taking a grip, or Russia invading Ukraine, or Ebola becoming a more serious health concern globally and having some economic ramifications. There's never any shortage of doom and gloom stories to apply retrospectively to market falls. And it's very important when the market does fall very rapidly, as it did in the first 15 days of October, and give us a very good buying opportunity. The question was there, what do you want to do? The market's offering you a discount. The market's offering you a good 10% discount, in fact, as good as 20% discount on many equity assets. If they were good value when they were 20% more expensive, well, they're even better value when they're 20% cheaper. So it's a challenge to us to retest our fundamental view, to retest valuations, and to say, well, you know, we probably want to take this on if the market seems to be moving for non-fundamental reasons. And it's quite a good indication of that if the complexities of the world, which we can't hope to understand fully, are being distilled into a single story, such as this growth fear or such as this deflationary fear. So backed up by the facts, we stepped in quite aggressively in the middle of October, and then, as luck would then have it, before the end of October, the market had completely changed its mind again. And so that was a very short-term episode. A longer-term episode, because I said there were two examples, a longer-term episode would have been the second half of last year, where when Ben Bernanke, the then Fed chairman, came out and said, he rang a bell saying, that's the end of your easing program. He said the word tapering that the market then ran off with and said, this is the most terrifying thing that policymakers can do. The long end of the bond yield curve then sold off very aggressively. We had a 25% sell-off in US Treasuries. Fundamentals, to our mind, stayed largely unchanged. And so again, we were stepping in on the other side of that. That took rather longer to play out, and that played out over the first 7 or 8 months of this year, when those yields came straight back in again to where they were back in May. So there have been two really good opportunities for this style of investing to prove its worth. Delivering a growing income stream is central to the Episode Income Fund, and central to that is looking after the capital. The capital is the engine of tomorrow's income, so on an ongoing basis we need to have a very clear eye on where our capital is invested. So the root of all of this is that the Episode Income Fund is an asset allocation product. We need to decide where the best place to invest is, either in equities or in bonds, and where within those asset classes, both in terms of the individual instruments and geographically, which markets are the most sensible places to put our customers' money. And ultimately this is about risk control, and controlling risk in its truest sense, not getting it mixed up with volatility, which the market will give you any day of the week. Risk is, what is the risk of my customers losing money? So what is the risk of me overpaying for something, ultimately, is another way of asking that question. So we have a very innate focus on value, and when we find that an equity, an asset class or a fixed income instrument is offering us value, we'll identify that good price, and then if the market offers us a better price, we need to have the emotional wherewithal to transact. When it's very difficult emotionally when the market's telling you how wrong you are by delivering its verdict with lower prices, but it's very important to be consistent to one's investment process and diligent in the application of that. So we identify value and then look for opportunities to exercise that through our episode framework, which brings in the behavioral finance element.